Valens Research, Uniform Financial Analytics.
So the first company that we're looking at today is United Rentals. For those of you who don't know, United Rentals buys and then leases out construction and other heavy equipment, right? So if you need a crane, if you need a backhoe, if you need anything else, you go to United Rentals and you can rent it from them, so you don't have to buy it. For United Rentals, just like every single company we look at using uniform accounting in the Valens Research app, we always start with one page, which is the PVP. What does PVP stand for? It stands for Performance and Valuation Prime. We're very literal people here at Valens, as I said, right? Performance, why do we call it performance? Because we're looking at return on assets, how profitable a business really is, and how much it can grow that business, asset growth. And then valuation, because we're looking at value relative to the assets of the company, right? How much the market is paying a premium to the investment the company has made. And we're also looking at relative to valuations relative to earnings, what we call value to earnings prime, or otherwise known as uniform accounting PE. What first jumps out to you here is we have orange bars and we have blue bars here. The orange bars here are the distorted, as reported ROAs, asset growth, PEs, price to books for this company, while the uniform accounting true blue is what the company's real profitability is. And the first thing that likely jumps out to you when you see United Rentals is this company's return on assets on an as reported basis is barely 5%. It's 6% and change. It is a very weak return business on an as reported basis. You would look at this company and you go, wow, this is a really boring leasing business. They're not generating a return at all. We don't want this company to grow. We don't want this company to do anything. Quite frankly, this is a pretty boring business to own. It's only when we look at the uniform accounting data that we can see this company's return is actually twice as high as reported metrics reflect. Right? This company is producing twice as much return for every dollar it puts into the business as you'd expect. Most leasing businesses really do generate a 5 to 6% return. Because of something that United Rentals is doing that's special, it's able to generate more than double that profitability. And that's really important because understanding why that is, what the company is doing, understanding that you need to focus on that can help you understand its competitive moat, its competitive advantage, how long it'll last. All things that you wouldn't even think to ask when you're talking to management or sell-side analysts or your other people on your portfolio management team if you were looking at the wrong data. But it doesn't just stop with ROA. Also, when we look at an asset growth basis, you can see how the distorted as reported asset growth misrepresents almost every single year how much this company has grown. You don't just misunderstand how profitable a business is using as reported metrics, you misunderstand how much it's grown. And similarly, look at this. It's not just value. It's not just performance, because right, performance historically is really valuable to understand what you should expect a business to do in the future, but it doesn't help you understand if you should buy or sell a stock. That's all about understanding what is the market expecting the company to do. And similarly, look here. If you look at the as reported metrics, you would think you had a company with a 6% ROA that was trading at a 5 times price to book. Right? Just intuitively, even if you don't understand there's a relationship between those two things, you would say that's really expensive for a company that generates a middling return to have a valuation that's 5 times its book equity makes no sense. But when we can understand this company's return is actually a lot more robust and it trades at a much lower premium to assets, all of a sudden things start to make more sense. And we see the same thing with value to earnings prime, right, which is our cleaned up PE versus an as reported PE. This is interesting because this highlights that even though as reported PE shows us a 16 times business, trading at below market average valuations, on a uniform accounting basis, it's actually trading at basically around corporate average valuations right now. Totally different conversation, right, that you'd be having in terms of saying, okay, do we really want to spend time on a company that's trading at market average valuations? Or are you asking, do we actually want to spend time on this business because it's trading at a discount to the market? You're literally thinking differently. If you screened on this name, right? If you said, hey, I want to find names that are trading at a 25% discount to the market, using as reported metrics, you'd think URI was. It's not. It's trading at market average valuations. These are the kind of different conversations you have when you look at the right data. And the last chart we have here is TSRR. TSR stands for total shareholder return. Now, this is the combined capital appreciation and dividend income you could get by owning this name each year. And the second R here, that little r, is relative. Relative to what? Relative to the relevant index for the company. Since URI is a US-based company, it's relative to the S&P 500. When this line is flat here, that means the company is performing in line with the market. When it's down, that means the company is underperforming the market. And when it's up, that means the company is outperforming the market, right? And what you can see, which is always very interesting, is there is often very little relationship between as reported metrics and total shareholder return. But when we look at it from a uniform accounting perspective, all of a sudden we can see, look at this, as ROA started to expand, TSR took off. As the company invested and also it kept on generating high return, TSR took off even more. It's only when we look at the real data that we can understand why the market's thinking what it's thinking. And it's only when looking at the real data that we can understand the right questions to ask for a company. Right, all this alone doesn't immediately tell us whether or not still we should buy or sell the stock. That's when these bars, these two light blue bars and these three white bars come into play, and why they're so powerful when we think about things from a uniform accounting framework on the Valens Research app. These two light blue bars and this light blue bar here are what Wall Street analysts are forecasting United Rentals to do for the next 2 years based on asset growth and return on assets when we take their as reported numbers and we push it through the uniform accounting framework, right? Wall Street analysts are expecting ROA to come down in 21 and 22 from where it was in 2019. These white bars are what the market is pricing United Rentals to do at a $23 billion market cap and a $320 stock price. In essence, Wall Street analysts are expecting returns to fall. And right now, the market is saying, yeah, they probably have it right, and returns are never going to improve back to where they were from 2013 to 2020. And this is fundamentally a different business. In a lower inflation, lower interest rate environment, et cetera, it's going to earn a lower return. But what we can do is we can say, wait a second, we think that expectations for asset growth to be slower going forward are reasonable, but we see no reason for why ROAs to decline to those levels and stay there. Let's see what happens if we say this company is going to generate ROA that's in the middle of where it was the last few years, which was around 14%. We can actually use the Embedded Expectation app to solve for what that means the company could be worth. We calculate here. What we can see is if we think that return on assets is going to rise for the business, but asset growth is going to be flat, all of a sudden this company isn't worth $320. It's worth $485. It's worth 50% more than it is right now. But the really interesting thing is we couldn't even have this conversation. But we couldn't even discuss, do we think that returns are going to recover to historically normal above cost of capital levels if we were looking at as reported metrics? Because we would think returns were always weak. We wouldn't even understand how good this company is to understand what's caused it to be this way and could it recover. And that's the power when we see uniform accounting, is it changes how we talk about a company.
Valens Research, the world's leading source for uniform financial analytics.